All right, everyone, welcome to a video on leverage and margin. Okay, for many of you who are just starting your trading journey, you're gonna open trading accounts with brokers and you need to understand, okay, how much leverage is a broker offering you? Okay, what does that mean in terms of having a margin account, in terms of how much do they take away from your trading account balance to put aside for you to open trades, and how do you not make the mistake of using too much leverage and blowing your trading account, okay, which goes hand in hand with risk management. So watch this video, enjoy it, okay? I have other videos on risk management which will connect to this video so you don't make any basic mistakes, okay, guys? Safe trading. All right, everyone, welcome to margin and leverage. Very important video that you need to understand, because when you open a trading account with whatever broker you decide to use, it's very important that you understand what is margin and what exactly is leverage, okay? So when we're trading the Forex markets or any market, okay, leverage is the capital a broker is going to lend you for you to place a trade in the markets. So we looked at our previous video of trading like lot sizes. So let's say we're trading one lot of 100,000 units of the base currency. Leverage is going to allow you to take that trade without you having to put up all of the money. All right. So when brokers offer you a leverage of say 100 to 1, this effectively means that you can borrow 100 times more than you're putting into your trading account. Okay, because when you take trades, the broker is going to put a certain percentage of your account as collateral for you to open a position. All right. So let's take a one lot position as an example, right? If you are trading one lot, and let's say your trading account is denominated in pounds, if you are trading a one lot position, which remember is equal to £10 per point, or for an example, if you was trading 10 lots, which would be 100,000 units, one standard lot, and you took 10 positions, that would be equal to 1 million units of the base currency. Or if you took a position of 20 lots, that would be 2 million, okay? And if you had leverage of 100 to 1, the broker is going to set aside just 1% of your trading account to put on that trade. Okay, so let's say you took a one lot position, the broker's going to say you have to put in £1,000 of your account minimum will be locked up as deposit to put on a trade. If you took up 1 million, so 10 lots, they're going to ask you to put up 10,000. If you wanted to take 20 lots, you'd have to put up 20,000 if you had a leverage of 100 to 1. Okay, so remember the lot size equals a certain amount per pip, and the leverage is basically telling you how much of your account has to be put aside to put on a trade. Okay, so here are the leverage tables. So basically, every time you put on a trade, if you have 100 to 1 leverage, you know you're 100 times leveraged. If you have a 200 to 1 leverage account, you're 200 times leveraged, 300 times, so on and so forth. Okay, sometimes you might get a 3% margin account, which means you're 33 times leveraged. Or if you have a 20 to 1 margin account, you'll be 20 times leveraged. I think in Europe at the moment, the minimum leverage account you can get, unless you're classified as a sophisticated investor with a lot of experience, I think a certain amount of capital as well, you'll be trading 33 to 1 leverage. Okay. Outside of Europe, brokers offer literally up to 500. I think some even offer up to 1,000 to 1 leverage. Okay. So obviously, for you to put on a trade, the broker's going to ask you to put aside a percentage of your account to put on that trade, okay, if you was to maximize your leverage. So the margin in your account is basically telling you what percentage of the lot size you have to have as collateral to put on the trade. So if you used to take a one lot trade, okay, 100,000 units, and you had a 1% margin, which is obviously 100 times leverage, because 1 goes into 100 times 100 times. So 1 is 1% of 100. Okay, if your trading account was 200 times leverage, well then you have to put aside 0.5% of the total value of lots that you're trading. If you're 300 times leveraged, well then you have to put down 0.33%. So basically, the higher your leverage, the less amount of margin you have to put aside in your trading account to put on the trade. Okay, so high leverage is good because it means that the broker takes a smaller and smaller amount of margin, so collateral, for you to put on any position size in the markets. So when you have a margin account, okay, when you open an account, whatever the leverage is on the trading account, you're going to understand automatically, okay, this is the percentage of my trading account the broker's going to put aside as margin for me to open the trade. So if you have a trading account which is 100-to-1 leverage, well, then you know you've got a 1% margin. So 1% of your account is put aside to open a trade. If you have, for an example, a 0.5% margin account, well, you know you're 200 times leveraged, okay? Because 0.5 goes into 100, 200 times, okay? 0.25% margin, you know you're 400 times leveraged because 0.25 goes into 100, 400 times, okay? So on and so forth. So it's really easy to understand. What we want to be doing is opening our account with brokers where we can have as much leverage as we can, because it just means for every trade we put on, a smaller and smaller amounts of margin are being set aside, which means we can open more trades. Okay, so let's look at some simple examples. Let's say you got a £10,000 trading account and you want to buy one lot of pound against the dollar. Okay, so you know that's 100,000 units of base currency. If you had a 0.25% margin account, you'd have to put aside £250 to open a one lot position. Okay, so that would leave your £10,000 account with £9,750 margin available for you to open more trades. Okay, again, if you had 0.5% margin, then you'd have to set aside £500 of your 10,000 account balance to put on a one lot trade, okay, which leaves you with 9,500. All right, obviously the higher the margin requirement, the less money you have to put on new trades, because the broker's locking up more of your account to put on the trade. Okay, in Europe, you're around 3 times 3%, okay, is your margin requirement, meaning you can basically leverage yourself 30% or 33%. Okay, so it's very simple. It's not really complicated. Just open an account with a broker where you can have as much margin leverage as you can, and the margin requirement is very, very low. All right. So when entering new trades in the market, it's important to know, for an example, how many units you're trading, number one, and then you can work out what is your margin. Okay, but you don't need to really work this out. All you need to know is how much leverage am I being offered by the broker, and how much of my account as a percentage is being put aside to put on that trade if you was to use the maximum amount of leverage. But we're never going to do that because it gets very risky. So let's look at this 10,000 account balance as an example. If we had a 10,000 account, okay, and the margin requirement 0.25%, which means you're 400 times leveraged, that means with a 10,000 balance, you can trade up to 4 million units of a currency, for an example, okay? However, 0.25% of 4 million is 10 grand. So if you buy an asset and you use the maximum leverage, the currency pair, for an example, would only have to move 0.25% for you to max out your leverage, and basically the trade would close because you would have lost 10 grand, okay? Because 10,000 is 0.25% of 4 million, okay? For an example, if we had a 0.5% margin account, meaning you're 200 times leveraged, and you had a 10,000 account balance, you can trade up to 2 million, okay? But again, the currency pair or whatever it is you're trading, if you maxed out your leverage and margin, would only have to go against you by 0.5%. Now remember, we looked at the example of Euro USD, where it fluctuates on average by 0.8% per day. So if you do stupid things and you start maximizing your leverage and taking huge trades in the markets, what you need to remember is if the trade goes against you by only 1%, if you have a 1% margin, you're going to get a margin call where the trade's going to automatically close. You've lost all of your trading account balance, and the broker's going to contact you saying, if you want to trade more, you have to put more money into your trading account. So obviously, we never use 100% of the leverage that we're being offered. It doesn't make any sense, okay? Just because the broker offers you a maximum amount of leverage that you can take, it doesn't mean it's right for you to use the full leverage, because as you can clearly see, if the currency pair or whatever you're trading goes against you by a small amount, you've lost everything. So the smart way to do it is, guys, what we want to do is use brokers with high leverage and low margin, okay, so we can enter multiple trades. But because we're using the risk management spreadsheet to know how much to put on the trade, you don't even have to worry about using 100% of your margin, because if you've already identified I'm only using 5% of my account, you're going nowhere near the maximum level of margin, okay? So you're safe, especially if you're using stop losses, because you know if it hits your stop loss, you're only going to lose 5% of your account. And if you've only lost 5% of your account, you've gone nowhere near the maximum level of leverage. All right, so leverage is good. It's very, very useful. When you open a trading account, it's going to tell you your leverage. So let's say you open an account and you know you've got a 500 to 1 leverage. Well, you know that whenever you take trades in the markets, the broker's going to only lock up 0.2% of your account to put on the trades, which means you have more room to enter multiple trades without a lot of your trading account being taken away and used as collateral. So the key point to remember, margin and leverage are linked. Okay, how many times does 1 go into 500? 500 times. Okay, so 0.20% goes into 500 to 1, 500 times. So you don't have to worry about it, guys. Okay, if you open trading account abroad using other brokers, you're going to get high leverage. Some of them even offer you 1,000 to 1, which basically means if you follow the risk management, you calculate your lot size, you're guaranteed not to lose only the amount that you want to lose, 2%, 1%, 5%, and you're going nowhere near using 100% leverage, because just remember, the moment the trade goes against you by 0.5% or 0.25%, if you're maximizing your leverage, guys, it gets very dangerous and you'll end up blowing your money. So just remember what it means. You're going to open a trading account with a broker. It's going to ask you, what leverage do you want? Just choose the maximum leverage, which means you're going to have a small amount of your account put aside as collateral. You can open multiple trades, and the risk management ensures you don't go anywhere near that maximum leverage. All right, so super easy. You can read through this PDF as much as you want, but just use high leverage with low margin, use a risk management, and you're safe.